The stock market is closed for the weekend, and the last reported closing price for Denison Mines Corp, ticker symbol DNN, on the NYSE American Exchange was $2.92 as of the end of trading on Friday, October 17, 2025, which represents a move down of approximately minus 5.5% from its previous close. Now, that sharp dip on Friday is the immediate headline, and it might lead many to think the recent upward momentum in the uranium sector is finally cooling off, causing a typical profit-taking pullback for a speculative asset like Denison. But here's the angle that demands a closer look. This price decline came despite the significant, genuinely positive fundamental developments the company recently reported, particularly the provincial regulatory approval for their flagship Wheeler River Uranium project, and the announcement of first production using the Sabre mining method at their McLean Lake joint venture. The expectation for a company that hits major operational and regulatory milestones is a sustained price surge, especially in a tightening commodity market. The reality of a minus 5.5% pullback immediately following such an advance suggests a profound tension between investor excitement, which drove the stock to its recent highs, and the cold, hard capital needs required to actually build a mine of this scale. It forces us to ask if the market is finally pausing its euphoria to acknowledge the massive upfront capital expenditures and the substantial time lag before those pounds of uranium hit the balance sheet in a meaningful way. Most casual investors in the uranium space viewed Denison Mines Corp simply as a leveraged bet on the rising uranium price, a narrative fueled by the global push for carbon-free baseload energy and the expansion of nuclear power. They see the supply-demand deficit for uranium, the fact that global production hasn't met demand for years, and they look for companies with Tier 1 assets in stable jurisdictions, which Denison absolutely has in the Athabasca Basin of Saskatchewan, Canada. The company is perceived as a leader among next-generation uranium developers, anchored by its Phoenix deposit within the Wheeler River project. The PEA for Phoenix outlined the potential for exceptionally low-cost production using in-situ recovery, a cheaper and cleaner alternative to underground mining. So the common belief is that Wheeler River is a future cash machine. Any progress toward production should, in theory, drive the stock higher. However, here's the reality check. Denison, like most developers, is not yet generating significant revenue. Its financials show high operating losses and negative cash flow, which is normal for a company still in the development phase, spending heavily on drilling, engineering, and permitting. The recent pullback likely reflects the market's acknowledgement of this funding gap. High trading volumes and institutional repositioning indicate some profit-taking after the stock's catalyst-driven rally. Institutions, including clean energy and uranium-focused ETFs and funds, remain the real drivers of Denison's long-term movement. In that context, Friday's decline looks less like weakness and more like a natural consolidation phase after a major milestone. Looking at the last month, Denison's rise closely mirrored uranium's strengthening price driven by geopolitical factors and increased long-term contracting from utilities. When the provincial approval for Wheeler River was announced, it removed one of the biggest overhangs, regulatory uncertainty, pushing the stock to new 52-week highs. However, what followed was a classic sell-the-news moment. Traders locking in profits ahead of potential capital raises that are inevitable for a project of this scale. Denison's business model is crystal clear. Transition from a development stage company to a low-cost uranium producer. Their Wheeler River project includes two key deposits, Phoenix and Griffin. Phoenix will use ISR mining for lower costs, while Griffin offers diversification through a conventional underground approach. Additionally, Denison owns 22.5% of the McLean Lake joint venture, home to the McLean Lake Mill, one of the few operating uranium mills in the region. The recent Sabre method production at McLean North demonstrates Denison's technical leadership and execution ability, key strengths that separated from less developed peers. Looking forward, the bullish thesis revolves around the growing global demand for nuclear power, the rising long-term uranium prices, and the execution of Wheeler River through federal approval and the final investment decision. An FID will unlock financing and move the project into construction, the next major catalyst investors are watching. But again, this comes with risks. High capital costs, potential permitting delays, or technical challenges with ISR mining. On the other hand, major upside catalysts include strong uranium contracts, cost efficiencies, or even a strategic acquisition by a larger miner wanting exposure to the Athabasca Basin. The key takeaway is Denison is not a pure spot price play anymore. It's transitioning into a project execution story. The Friday dip was a structural pause, not a collapse. The broader clean energy and nuclear narrative remains very much intact, and Denison continues to be one of the most strategically positioned uranium developers in North America. So now I want to hear from you. What's your uranium price target for 2026? Do you see it breaking past its recent highs? Drop your thoughts in the comments below. If you found this breakdown helpful, ETM like the video, ETM comment your take on DNN, ETM subscribe for more in-depth stock analysis and updates on the uranium and clean energy sector. WII disclaimer. This content is for educational and informational purposes only and does not constitute financial advice. The opinions expressed here are based on publicly available data and should not be relied upon for investment decisions. Always conduct your own research or consult with a licensed financial advisor before making any investment.